Good afternoon. My name is Khai. Welcome everyone to the analysis of financial information. We have two parts in today's analysis. The first part will analyze the performance of HBQ from 2013 to 2017. In the second part, we'll compare all three companies, AAPL, Ngoc, and HBQ, operating in the same industry and give recommendations about choosing which companies under the view of investors and suppliers. Now, let's begin. First is liquidity. The liquidity of a company is the ability to pay short-term debt obligations. Today, we'll look at the current ratio, quick ratio, and the working capital. The current ratio shows how many times over the firm can pay its current debt obligations based on its assets. Even though the current ratio slightly decreased from 2013 to 2014 overall, there was still an upward trend in the current ratio. All the current ratio were above 1 times, and current ratio in 2017 was 1.15 times, so the firm improved its liquidity from 2014 to 2017. Quick ratio looks at how well the company can meet its short-term debt obligations without having to sell any of its inventory to do so. In the balance sheet, we can see the quick ratio of the company in 2017 is 0.83 times, although the quick ratio was fluctuated and had an overall increased trend from 2013 to 2017 by 0.05 times. The ratio still shows that the firm cannot meet its short-term debt obligations without selling any inventory because all quick ratio is below 1 time. In this case, it needs to improve the quick ratio to at least 1 time in order to stay solvent and pay its short-term debt without selling inventory. Working capital is the difference between current assets and current liabilities. It's clearly to see that the company has a positive net working capital. From 2013 to 2014, the company's net working capital plummeted from $4,781 million to $579 million, but then soared up in the reverse years. For 2017, this company's net working capital was $6,410 million, so its net working capital has improved from 2014 to 2017. To sum up, this company has improved its liquidity position from 2013 to 2017 as indicated by all three metrics we have looked at. The current ratio and the net working capital positions have both improved. The quick ratio shows that the company still has to sell inventory in order to meet the current debt obligation, but the quick ratio is also improving. Next is efficiency. Efficiency ratios measure a company's ability to use assets and manage its liability effectively. So today we'll look at days inventory, days sales outstanding, and cash conversion cycle. Days inventory shows how long it takes a company to turn its inventory into sales. Generally, the lower days inventory, the better it is. In the balance sheet, we can see the days inventory of the company in 2017 is 26.81. Overall, days inventory of the company has worse than before. Days inventory in 2013 was 23.92, much lower than 2017, almost 3 days. In other words, HBQ company in the recent years spent more days to sell its entire inventory. Days sales outstanding is a measure of average number of days that it takes a company to collect payment after a sale has been made. HBQ's days sales outstanding in 2017 was 48.65 after an increasing in a 3-year period from 50.71 to 52.46. The days sales outstanding declined significantly in 2017 by almost 4 days. This was a good sign because a lower days sales outstanding also means that it takes a company fewer days to collect its account receivable. Cash conversion cycle measures the length of time between the company purchase of inventory and the receipt of cash from its current account receivable. From 2013 to 2016, its cash conversion cycle was extremely high and peaked in 2014 and 2015 with 24.28 In 2017, however, the cash conversion cycle decreased remarkably with just 11.08. This value means in 2017, the company was healthier, collected outstanding payments more quickly, correctly forecast inventory needs, or pay its bills slowly. To conclude, even though days sales of inventory was still high in 2017, which means it took the company longer to sell its inventory, overall, HBQ company has improved its efficiency position from 2013 to 2017, when its days sales outstanding decreased considerably, leading to a steep reduction in cash conversion cycle. The last one is profitability. Ratios show a business ability to generate earnings related to its expense. Today we'll look at return on assets, earning before tax margin, and revenue. Return on assets is an indicator showing how efficiently a company manager uses assets to generate earnings. The company return on assets in 2017 was 4.8%. In 2015, it bottomed with negative 10.62%, even though the company has increased its return on assets back in 2016 and 2017. Compared to the previous years, it was still lower, approximately 2.5%. In other words, HBQ generated less income than it did in the past. Earning before tax margin shows companies' earning before tax as a percentage of revenues. In 2015, HBQ was at risk of bankruptcy due to the negative value, negative 9.91. In 2016 and 2017, the company has managed to overcome the problem, as its earnings before tax margin was positive again around 5.8. The result, however, still reveal a low profitability of the company's operations, as the earnings before tax margin was less than 2013 and 2014, which were 8.71 and 7.06. This data implies a dropping operational profitability of HBQ due to the downward trend of earnings before tax margin compared to previous years. Revenue is the amount of money that a company actually receives during a specific period. It's clearly to see that HBQ's revenue slowly declined from 2013 to 2017. In 2013, its revenue was 126,033 million US dollar, but in 2017 it dropped down to 111,455 million US dollar. In other words, the company has been suffering losses in the 4-year period. In conclusion, as we have analyzed, the company's profitability position had decreased from 2013 to 2017. The return on assets, earnings before tax margin, and revenue have declined, which shows a reduction in the company's ability to generate earnings, and it needs to improve its profitability in order to gain more profit. Now, we'll move to the second part. Investors, for obvious reasons, are most concerned about profitability. Their investments are at risk and they expect to gain maximum. We can see that despite the falling in revenue of NOK and HBQ, AAPL's revenue has increased gradually from 2013 to 2017. APL's operating cash flow was extremely high, with 89,713 million US dollar in 2017 compared to NOK and HBQ, which was just 72 million US dollar and 12,333 million US dollar. About return on assets and return on equity, NOK percentage was even negative in the recent years, with negative 2.23% and negative 8.47% in 2017. Both remaining companies, even though all had a positive percentage in return on assets and return on equity. Return on assets of AAPL still dominated for 5 consecutive years. In 2017, return on assets and return on equity of AAPL was 18.01% and 33.61%, while return on assets and return on equity of HBQ was just 4.8% and 18.57%. These statistics show that AAPL's profitability was very solid and dominant compared to other companies. Next is the comparison about efficiency. AAPL days inventory was the lowest of the three companies. On average, NOK's day inventory was 35 days, HBQ's was 26 days, and AAPL's was just 5 days. Furthermore, with a low value in days sales outstanding and a long payable period, AAPL had the most efficiency compared to NOK and HBQ. As investors, choosing AAPL is definitely a wise option for a future profit. As suppliers, however, HBQ company is still a considerable option due to the least payable period, which means suppliers can receive money faster than from other companies. This will benefit the suppliers in the short term, even though this might cause a bull on liquidity for HBQ. Last but not least is liquidity. Suppliers are concerned whether they will get paid the amount promised to them on time. For this reason, they are very concerned about the liquidity of the firm. As we have discussed above, inventory is not easy to liquidate. We cannot just sell the entire inventory in half an hour. Therefore, by evaluating quick ratio, suppliers can have an overview of the company's ability to pay short-term debt, excluding inventory. This will help suppliers make more precise decisions in choosing which company to cooperate with. NOK met the requirement with all the quick ratio above 1. On the other hand, HBQ had its entire quick ratio below 1, and AAPL showed only one quick ratio below 1 in 2017. However, when we look more closely, AAPL performed the best in terms of financial leverage. In 2017, HBQ reported the highest amount of financial leverage with 3.86 compared to other companies, slightly less than NOK with 3.89. However, financial leverage of AAPL was just 2.08, much lower than HBQ and NOK. Leverage is applied to avoid using too much equity to fund operations. Thus, financial leverage not only provides useful information for suppliers to analyze, but it also helps investors in evaluating the potential company, bringing the most profit for them in the future. All in all, from investor perspective, AAPL is the most suitable company to invest in. AAPL show a remarkable dominance in profitability, far beyond the remaining companies with the highest revenue and operating cash flow in 5 consecutive years. It also held first place in the most valuable dividend and earnings per share. Along with profitability, AAPL's efficiency was undeniable with the shortest days inventory, 5 days in average. Its quick ratio, even though dropped below 1 in 2017, AAPL's financial leverage was reasonable with just 2.08, leading to a great liquidity. With all those successful results and high liquidity, it's inevitable that suppliers will also choose AAPL. That's the end of my presentation. Thank you for listening.